Imagine if anyone could buy life insurance on a complete stranger. Sounds like a movie plot, right? But without certain safeguards, life insurance could actually turn into a gambling contract where people profit from the deaths of others. That's where insurable interest comes in. In this video, we are going to break down what insurable interest is, why it is required, and how it keeps life insurance ethical and legal. Stick around because understanding this could help you make better financial decisions. So, what exactly is insurable interest? Simply put, this way, when you take out a life insurance policy, you must have a financial or emotional reason to insure that person, right? It means you would suffer a genuine loss if they passed away. For example, you can take out life insurance on your spouse, children, or business partner, or even a key employee because their loss would impact you financially or personally. Now, here is why this rule exists. Without insurable interest, anyone could buy a life insurance policy on someone they don't even know and cash in when they pass away. That would make life insurance a form of gambling instead of a safety net for loved ones. Imagine taking out $1 million policy on a stranger. That creates a dangerous incentive where some people might even try to manipulate or harm others for financial gain. Sounds like a crime movie, right? Well, in reality, this has happened before, which is why insurance companies and regulators enforce this rule strictly. Okay, let's break down a real world example of how life insurance can be used for charitable giving while still following the rules of insurable interest. Let's say John and Sarah are a married couple. John buys a life insurance policy on Sarah because, as her spouse, he has an insurable interest in her life. If she were to pass away, John would experience a financial and emotional loss. So the insurance company approves the policy. Years pass, and thankfully, Sarah is living a healthy life. But John has a change of heart. He wants to leave a lasting impact on the world. He decides to change the beneficiary of the policy from Sarah to a charity he deeply cares about. At this point, the charity had no insurable interest in Sarah's life, but that doesn't matter. But because insurable interest is only required at the time of policy purchase, not at the time of a claim. Years later, Sarah sadly passes away. Since John had updated the beneficiary to a charity, the life insurance company pays out the death benefit directly to the charity, even though the charity never had an insurable interest in Sarah. Let's look at another scenario. What if you could take out a life insurance policy on a complete stranger and cash in when they pass away? Sounds like an easy payday, right? Well, not so fast. This is called a wagering contract and it's completely illegal in life insurance. Let me explain why. Let's say Bob decides to take out a life insurance policy on a random guy named James. Bob has no relationship with James, but he lists himself as the beneficiary, expecting to collect when James passes away. Sounds sketchy, right? That's because it is. Since Bob has no insurable interest, meaning he wouldn't suffer any real financial loss if James died. This would be considered a wagering contract and it's totally illegal. Now, why this is not allowed? Because life insurance is meant to protect families and businesses, not be used as a bet on someone's life. If policies like this were allowed, people could take out insurance on strangers or even celebrities just to profit from their deaths. That's why insurance companies require insurable interest at the time of purchase to stop fraud and prevent life insurance from becoming a get rich quick scheme. So, there you have it. Life insurance isn't just about financial protection, it can also be a way to create lasting impact. Whether you want to support a charity, leave a legacy, or secure your family's future, understanding these rules can help you make smarter financial choices. That's why insurance companies require insurable interest at the time of purchase. It keeps the industry ethical, prevents fraud, and ensures that policies serve their true purpose, which is protecting families and businesses. To wrap up, if you don't have a real financial or emotional connection to the insured person, you cannot take out a life insurance policy on them. That's the law. If you find this video helpful, hit that like button, subscribe, and drop a comment below.